Welcome to The Explainer. Today, we're going to break down a really fascinating investment case study. And trust me, it uncovers a crucial lesson that every single smart investor needs to know. It's a story about some pretty incredible numbers and some well-hidden truths.
Okay, so imagine you're looking for your next investment, and you come across this, a company with a 74% return on equity in 1 year. I mean, think about that. For every dollar of shareholder money, it cranked out 74 cents in profit. That is an absolutely mind-blowing number.
Now, what if I told you that same company was trading at just over 3 times its earnings? You know, that's a key metric for how pricey a stock is. And this is just incredibly cheap. It basically means you could, in theory, get all your money back in just over 3 years if the profits just stayed the same.
So on the surface, this thing looks like the investment of a lifetime, right? Super high returns, super low price. But is it really the perfect stock, or is it a perfect trap just waiting for an investor to fall into? All right, let's dive in and find out. To figure this out, we're going to use a classic investing framework, inspired by the man himself, Warren Buffett. We're going to take a close look at a company called WealthTrust Securities. It's time to pop the hood and see what's really driving those incredible numbers. So the very first principle is super simple. Only invest in what you can actually understand. It's what Buffett calls the circle of competence. And lucky for us, WealthTrust business is actually pretty straightforward to get your head around.
They make money in 2 main ways. First, there's the interest they earn on the government bonds they hold, minus what it costs them to borrow money. And second, they make what are called trading gains when the market price of those bonds goes up. Simple enough?
And right here, this is the core challenge. You see, bond prices go up when interest rates fall. So that means a huge chunk of this company's profit really depends on something that is notoriously difficult to predict: where interest rates are headed. It's a massive wild card sitting right at the heart of their business.
All right, let's move on to the next step in our investigation. We need to figure out if this company has any kind of lasting competitive advantage. Something to protect it from all the other guys. In Buffett's world, this is called an economic moat. Just think of it like a moat around a castle. It's a structural feature that keeps invaders, or in this case competitors, out. It could be a crazy strong brand, a patent, a unique technology, anything like that.
And this line, well, it really gets to the heart of the problem. The main product that WealthTrust sells, a government treasury bond, is a pure commodity. I mean, the bond you buy from them is the exact identical same thing as one you'd buy from any of their competitors.
And because their product isn't unique, it has some major consequences. They have zero pricing power, none. The market decides the price of bonds, not them. And there are no switching costs. A big customer will jump to a competitor to save even a tiny fraction of a percent. Their defenses are, well, they're basically non-existent.
So the verdict here is crystal clear. This is a no-moat business. Its success depends entirely on being really smart and efficient day to day, and maybe getting a little lucky with interest rates, not on some durable, protective fortress.
Okay, now we get to the real climax of our investigation. Where in the world did that unbelievable 74% return on equity actually come from? Let's break down the numbers from that one incredible year, fiscal year 2024. Whoa, just take a look at this. This bar chart tells a really dramatic story. In fiscal 2024, profits were a massive $4.9 billion. But just 1 year later, they plummeted down to $1.19 billion. This huge drop is our biggest clue that something really unusual was going on. And boom, this donut chart solves the whole mystery. In fiscal 24, the company booked over $7 billion in net trading gains. This one single item made up the vast majority of that record-breaking profit. This wasn't their normal, recurring business income at all.
So that amazing performance, it wasn't the sign of a wonderful growing business. It was a temporary sugar high, a one-off windfall that happened because of a historic, dramatic drop in interest rates in the country. As those rates crashed, the value of the bonds they were holding just soared, creating a massive but temporary trading profit.
To expect that kind of performance to happen again would be a huge mistake. Like the analysis says, it's kind of like trying to win a lottery by betting on yesterday's winning numbers. The event already happened, the opportunity is gone. And this brings us to one of the most common and, frankly, dangerous mistakes an investor can make. It's a trap that is so easy to fall into when you see numbers like the ones we started with. It's called rearview mirror investing. It's the mistake of trying to drive your car forward while staring intently at what's already behind you. You're making decisions based entirely on past events, just assuming they're going to perfectly predict the future.
it doesn't work.
This slide just sums up our entire investigation perfectly. When we put WealthTrust up against a Buffett-style checklist, you see a really mixed bag. I mean, sure, it gets a check mark for being understandable and having good management. But look at the red flags. It has no durable moat, its returns are all over the place, and the current price doesn't really offer that margin of safety a value investor wants to see. It's definitely not a clear-cut yes.
So, after all that digging, what is the #1 crucial lesson for you, the smart investor, to take away from this whole thing? Well, it boils down to one of the most fundamental ideas in all of finance.
And this is the bottom line, right here. The price is what the market is asking you to pay, in this case, $7 per share. But the value, based on our analysis of its normal sustainable earnings, that's what you actually get. And that's closer to $6.70. You're being asked to pay more than what the business is really worth in the long run.
You should always remember this timeless piece of wisdom. The stock market is full of exciting prices, but real success comes from finding real, durable value. This case study is the perfect example of why you can never, ever confuse those two things.
So, the next time you see a stock with those incredible, eye-popping numbers, I want you to ask yourself this question. Is this sustainable quality the result of a truly great business with a deep moat? Or is it just the fading glow of yesterday's good luck? A temporary sugar high that's about to wear off?